Hello and welcome back to the Financial Freedom Show. In today's episode, we're going to be talking about SCHD and why it's one of the most popular exchange-traded ETFs for dividend-focused investors. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos that we produce on this channel, as well as check out the description for the membership program. If you join our membership program, you can see our videos a day before they're published, as well as have access to our private Discord and have your name posted at the end of every single video we publish. So if you enjoyed today's video, please be sure to comment down below if you're adding SCHD to your portfolio. And without further ado, let's get into today's video. The Schwab US Dividend Equity ETF, or SCHD, is one of the most popular exchange-traded funds, or ETFs, for dividend-focused investors. Known for its impressive track record of performance, low expense ratio, and emphasis on high-quality dividend-paying companies, SCHD has become a cornerstone for those seeking both income and long-term growth. In this video, we'll delve into what makes SCHD stand out, its composition, benefits, and potential drawbacks, helping investors determine if it's right for their portfolios. SCHD was launched by Charles Schwab in 2011 with the goal of providing investors with exposure to a diversified portfolio of U.S. companies known for consistently paying dividends. This ETF tracks the Dow Jones U.S. Dividend 100 Index, focusing on companies with strong financial health and a reliable history of dividend payments. As of 2025, SCHD has become synonymous with stability and consistent returns, appealing to income-oriented investors. Here's some key details about SCHD. The expense ratio is just 0.06%, which is one of the lowest in its category. It typically has a dividend yield that ranges around 3 to 4%. It's closer to 4% now. It has a dividend payment frequency of quarterly, and its holdings are approximately 100 US-based large-cap companies. SCHD's portfolio is carefully curated based on stringent criteria. Companies included in the Dow Jones US Dividend 100 Index must meet the following requirements: a dividend history, a minimum of 10 consecutive years of dividend payments, financial health, strong metrics in not only return on equity, or ROE, but also free cash flow to debt and other financial stability indicators, and yield and growth, favorable dividend yields, and a track record of consistent dividend growth. The ETF's holdings can span various sectors with a significant emphasis on industries like financials, consumer staples, healthcare, and industrials. This sector diversification helps mitigate risks associated with economic cycles. Some top holdings often include companies such as PepsiCo, Cisco Systems, Home Depot, and Merck. These are some of the best holdings in SCHD. There's many benefits in investing in SCHD. One of the main benefits is its low expense ratio of just 0.06%. SCHD is one of the most cost-effective dividend ETFs available. This ensures that investors keep more of their returns over time. It also has an attractive yield and dividend growth. SCHD offers an appealing combination of both solid dividend yield and consistent growth, making it a reliable income source for retirees or anyone seeking passive income. It also has strong performance. SCHD has consistently outperformed many of its peers in the dividend ETF space. Its focus on quality companies with strong fundamentals contributes to its resilience during market downturns. It has good diversification. By holding approximately 100 companies across various sectors, SCHD offers diversification, reducing the risk associated with individual stock investments. And lastly, it's tax efficient. As an ETF, SCHD is generally more tax efficient compared to mutual funds, which can be advantageous for long-term investors. There are still some potential drawbacks for investing in SCHD. Limited international exposure. SCHD focuses exclusively on U.S. companies, which means that the investors miss out on potential opportunities in international paying dividend stocks. Sector concentration. Although diversified, SCHD's portfolio often has higher exposure to certain sectors such as financials and consumer staples, which may underperform during specific economic conditions. And lastly, dividend yield variability. While SCHD offers a competitive yield, it can fluctuate depending on the market conditions and changes in its underlying holdings. So why should you invest in SCHD? SCHD is best suited for income seekers, investors who are looking for regular dividend income, retirees, those seeking a reliable income stream to supplement retirement savings, long-term investors, individuals focused on wealth building through compound dividend reinvestments, and cost-conscious investors, people who prioritize low fees to maximize returns. Dividend ETFs have significantly gained popularity among investors for their ability to provide consistent income, diversification, and the potential for long-term growth. These funds are designed to track a basket of dividend-paying stocks, offering a simplified way for investors to gain exposure to high-quality companies with a strong history of returning value to shareholders. Whether you're a retiree seeking income or a young investor building wealth, dividend ETFs present a compelling case for inclusion in any portfolio. There's many benefits to owning dividend ETFs. The first is consistent income streams. Dividend ETFs are particularly appealing for their ability to generate steady income streams. By investing in companies with reliable dividend payments, these ETFs allow investors to receive periodic distributions, which can be particularly useful for retirees or those seeking passive income. Unlike individual stocks, dividend ETFs provide built-in diversification, reducing the risk of relying on a single company's dividend performance. They also offer diversification. One of the primary advantages of ETFs is diversification. A dividend ETF holds dozens or even hundreds of dividend-paying companies across various sectors, mitigating the risk associated with individual stock performance. For example, while a company's single dividend may be cut during economic downturns, the broader portfolio of an ETF is more likely to sustain payouts. There's also a potential for long-term growth. In addition to providing income, many dividend-paying companies are also known for their financial stability and long-term growth potential. Dividend ETFs often include companies with a history of increasing their payouts over time, making them a good option for investors looking to grow their capital. Reinvesting dividends can further amplify this growth through the power of compounding. There's also ease of access and management. Dividend ETFs offer a simple, hands-off way to invest in a diversified portfolio of income-producing assets. For those who lack the time or expertise to research individual stocks, ETFs provide professional management and exposure to well-curated indices. This makes them an ideal choice for beginners and seasoned investors alike. And lastly, cost efficiency. Many dividend ETFs, such as the Schwab US Dividend Equity ETF, or SCHD, are known for their low expense ratios, ensuring that investors retain more of their returns. This cost efficiency, combined with the ability to avoid frequent trading fees associated with individual stock investments, makes dividend ETFs a financially sound option. Why do dividends matter? Dividends are a crucial component of total returns. Over long periods, a significant portion of the stock market's overall returns has come from dividends and their reinvestment. Dividend-paying companies are often more stable and established, offering a degree of safety compared to high-growth companies that reinvest their profits into expansion. Furthermore, during market downturns, dividend payments can provide a buffer against falling stock prices. Investors can rely on this income to meet expenses or reinvest at lower prices, which can enhance long-term portfolio performance. There's a few things you should consider when choosing dividend ETFs. While dividend ETFs offer many benefits, it's essential to consider certain factors. You're going to want to look for the expense ratio. Look for ETFs with low expense ratios to ensure higher net returns. Yield versus growth balance. Some ETFs prioritize yield, while others focus on dividend growth. Choose one that aligns with your investment goals. Sector concentration. Understand that the sectors of the ETF that they're heavily invested in, as some of these have higher exposure to industries like financials or utilities. And tax efficiency. Dividend ETFs can be tax efficient, but be aware of the tax implications of dividend income, especially in taxable accounts. So why should you invest in a dividend ETF? Dividend ETFs like SCHD are an excellent option for investors seeking a combination of income, diversification, and long-term growth. By providing exposure to a broad array of dividend-paying companies, they reduce the risk of individual stocks and simplify the portfolio's management. Whether you choose a well-known option like SCHD or explore other dividend-focused funds, these ETFs can play a pivotal role in achieving financial stability and building wealth over time. With their numerous advantages, SCHD and other dividend ETFs deserve serious consideration for outperformance in 2025. So if you enjoyed today's video, please be sure to hit the like button and subscribe to stay up to date with the latest videos we produce on this channel. Feel free to leave a comment down below if you're buying SCHD in your portfolio. I'd love to hear from you in the comments. And check out the link in the description to join our membership. You can have your name featured at the end of every single video we publish, as well as access to our private Discord and access to our videos a day before they're published. So hope you enjoyed, and thanks for watching. I'll see you in the next one.